Hi, thanks for joining us today. We have Warren Stickney, and he's going to tell us a little bit about what asset classes we should be taking from when we look for retirement. So Warren, tell us, oftentimes we hear clients asking what bucket or what asset class they should be taking from when they start to look at money that they need to live on.
Yes, that's a great question, and it is one that comes up all the time and is somewhat counterintuitive. People all the time will say to me, well, Warren, why don't we take money out of the thing that is doing the worst and liquidate that for money I need in retirement? And the whole goal of investing is essentially to buy low and sell high. So when the market's doing extremely well, what we want to do is take the money out of the asset that has made the most money, and in essence, that's a form of rebalancing. And in a perfect plan, we would also have a bond ladder running, which is designed to have bonds of specific maturities that provide this income that you need. So if we're doing it the right way, if the stock market is down, we then are withdrawing from the bond ladder. If the stock market is way up, we're liquidating investments we've made a significant gain on, and thus keeping your plan in balance.
That makes sense. So oftentimes people will ask, which bucket do I take them from? Should I take it from an IRA? Should I take it from after tax, from a Roth? Tell us what you think about that.
So that is a great question, is one that often requires more than just a tiny bit of thought and analysis. So here's some general rules. If you're paying tax on an investment anyway, we like to see you pull that money out and live on it, because of course you're already paying tax on it. For other money that you need to start living on, et cetera, we then look at the symphony, if you will, between IRA money that you might have and after tax money that's invested in stocks, et cetera, that would produce capital gain income. And so what we want to do is be thoughtful about this. If you're over age 70 and a half and have to start taking the money with RMD, obviously we would calculate and want to take that out first, and then apply a bunch of rules that largely deal with issues in the tax code to determine which bucket you should pull from.
That makes sense. And oftentimes you've spoken about a tax cliff. Can you talk a little bit about that?
Yes, I mean, thank you for bringing that up, because it's critically important for people to understand. What's interesting with the new tax code that came into place in 2018 is that, for example, with a married couple, if we just take a look at capital gains rates for a couple making below $78,000 a year are zero. And $1 above $78,000, and they go to 15%. And then at the next cliff, they go up to 20%. So that's an area where we look at in planning and say you hardly would want to liquidate something and create another $500 of income and suddenly make $70,000 or $78,000 of capital gain income taxable. So if we look at that and combine it, because many people would say, well, I can't live on $78,000. Well, in addition to the $78,000, we get the standard deduction of $24,000. So that's north of $100,000 of income. And if we play this right, the actual tax rate on that could be approximately 8 to 9%. So what we want to look at is how much money should be coming in from IRA money to keep us right below those thresholds, and then to pull the rest out from capital gain income and arrange one's affairs that we're not generating a lot of ancillary investment income, and that under the new tax code is going to be even more important to take into account. The other thing that's counterintuitive, and there's great articles that we will send you, for instance, is if we look at Medicare Part A and B premium, the difference in surcharge, meaning additional money that one would have to pay in premium that comes out of their Social Security check, goes from a low of $54 a month surcharge up to a high of a $325 a month surcharge. That is a significant hit to pay for doing something that can be relatively innocuous in terms of one's investment thinking and not realize the impact in their plan. So
wow, it sounds complicated.
It is complicated, and it takes, as I said, more than a tiny bit of analysis. And we are experts in analyzing that and helping people arrange their affairs such that they're not at the mercy of the absolute highest tax bracket forever.
Sounds great. Well, thank you so much for explaining that to us.
Well, thank you. I love answering questions and love being a resource. So that's what I'm here for.
Perfect. Thanks.
Thank you.